The ultimate goal of any active investor is to maximize portfolio returns. We consume books, videos, and interviews in the hopes of absorbing the wisdom of legendary hedge fund managers like Bill Ackman or Joel Greenblatt, so that we too can one day develop the skills to grow our wealth at rates commensurate with those of investment professionals. But perhaps the two most influential figures in my education as an investor have been Nassim Taleb and his protege Mark Spitznagel. They taught me the Tao of roundabout investing. To win, you must love to take small losses, for these form the seeds of future glory. It is the permanent loss of capital resulting from large losses that one truly needs to worry about. Everything else is just noise. One fundamental principle that hardly ever gets brought up is the fact that portfolio returns are non-ergodic. Translated into plain English, this means that the majority of investors will never get the often promised 10% annual returns on their investment, and the reason for this is what Spitznagel calls the volatility tax. The higher the volatility, the lower the returns, and losses are absolutely destructive. Hence why Warren Buffett's cardinal rule is, never lose money. This is because of path dependency and due to the fact it takes a 100% gain to recover from a 50% loss. Okay then, how can we avoid losses? Maybe we can diversify into bonds and try and improve our compound annual growth rate, CAGR for short, compared to an all-equity benchmark like the S&P 500. This, unfortunately, is not the case, because a diversified portfolio consisting of 75% SPX, that is, the S&P 500 index, and 25% bonds only added 0.1% to CAGR. 0.1% is better than nothing, but it still isn't enough to solve our problems. Okay, what about hedge funds? Hedge funds are, to paraphrase Peter Lynch, diversifiers. Mark Spitznagel. This is a rather incendiary assertion on Spitznagel's part, but the data bears out, as the average hedge fund actually lowers CAGR, leaving me wondering what the point is in paying the standard 220 hedge fund fee structure, when one would be better off just holding the S&P and bonds instead. Maybe it's a status thing, I don't know. Now, Mark Spitznagel doesn't reveal his secret proprietary sauce, but he isn't shy to expound on the basic philosophy behind his risk hedging strategies, even going as far as giving us concrete, somewhat actionable examples myself and others have been able to reverse engineer. Former hedge fund manager Jesse Felder did exactly this in an article published in August 2016, in which he explores Spitznagel's option-based portfolio hedging strategy. Spitznagel's simple backtesting example calls for the purchase of 2-month 0.5 delta puts, approximately 30% out of the money. While I've used this strategy in isolation in the past, its proper use is in ensuring a long equity portfolio, which Felder sets at $100,000 in this hypothetical example. As such, we'll be buying 0.5%, or $500, in options every month and selling at the end of the month. For this backtesting exercise, Felder uses the SPY, an ETF which tracks the S&P 500 index, and which was trading at $219.40 at the time. We're interested in puts with a strike price 30% below that, so we'd look to purchase the October 21st, 2016 puts with an exercise price of $155. At $9 per contract, we would be able to buy 55 of the October 155 put options for $495. Felder then simulates the effects of a 20% decline in the price and a volatility spike to levels consistent with previous crashes, like in October 2002. The VIX, which is often used as a proxy for market volatility, peaked at around 45 in the lows after the 2002 crash, at 48 during the market turbulence after the US lost its AAA rating in August of 2011, and at just over 53 during the 2015 crash. So as you can see, this level, what practitioners like Spitznagel referred to as the implied volatility surface, has remained fairly constant in quote-unquote vanilla crash situations. In years like 2008 and 2020, we can expect readings in the mid to high 80s. Assuming a 20% decline and an implied volatility of 55, that is, 45 plus 10 points for 10% out of the money puts, each of Felder's contracts in this hypothetical simulation would now be worth $328.10 apiece. 55 times 328.1 comes to just over $18,000 in total, allowing us to virtually negate a $20,000 loss in our equity portfolio for next to no cost. This strategy not only insures against losses, but it actually maximizes CAGR over time. Here's why. Regular investors and pension funds are counting on 9 to 10% average annual returns, the so-called ensemble average, but the existence of extreme up and down swings in the market means this elusive benchmark remains forever out of reach. Here's an example provided by Mark Spitznagel himself. 10-year average total returns for the S&P 500 through to the end of 2017 totaled approximately 10.4% annually. So naturally, one would expect $1,000 invested in 2008 to have turned to approximately $2,690 by December 31st, 2017, right? $1,000 times 1.104 is $1,104. $1,104 times 1.104 is $1,219. $1,219 times 1.104 is $1,346, and so on and so forth. The problem is that a 37% drop in 2008 and a lackluster performance in 2011 and 2015 greatly reduced realized investor returns. Rather than finishing 2008 with $1,104, investors actually welcomed 2009 with a measly $630 in their brokerage accounts, only breaking even almost a full 4 years later in 2012. The stock market roared higher thereafter, albeit with some turbulence in 2015 and 2016, but the initial losses had a devastating effect on the annual compounding rate, which turned out to be a staggering 16% lower than the expected rate of return. This is true even if we only take the 5-year period between January 1st, 2016 and December 31st, 2020. Even amidst an unprecedented recovery propped up by government stimulus and the Federal Reserve, investors still fell almost 3% short of the idealized returns of the S&P 500. Also, while retail investors watched in horror as U.S. capital markets opened at limit down day after day after day, and gravity worked its magic on their portfolios, Mark Spitznagel was sitting pretty, his fund having returned 3,600% in March 2020. Whether markets rebounded or continued trading at significantly depressed levels for an indefinite period of time was of little consequence to their rockstar hedge fund manager and prize-winning goat cheese producer. The same, however, cannot be said for the bulk of retail investors worldwide, and for pension funds. In a way, idealized annual returns exist on the ethereal plane of someone with a time horizon spanning decades or even centuries, in the case of multi-generational wealth passed down from father to son, and so forth. The problem is that this time horizon is considerably more finite for people hoping to retire on their investments, or for people needing to liquidate part of their portfolios to cover, for example, a medical emergency or a loss of income after being made redundant at their jobs, etc. The only way to prevent this is therefore to avoid large destructive losses. Unfortunately, the strategy I outlined earlier has its weaknesses. After surging to 85 in March of 2020, the VIX continued trading at elevated levels throughout the year and into 2021, to such an extent that Felder's backtest would no longer work in the current environment. I ran the experiment with March 19th, 2021 out-of-the-money puts on the SPY, which traded at $375.70 at the time of making this video. We would therefore be purchasing put options with a strike price of $263, which now traded at the staggering price of $75 per contract. This exorbitant price tag allows us to purchase only 7 contracts as opposed to 55 back in 2016. Assuming a 20% price decline and the same volatility level of 55 now yields us $488.88 per contract for a total portfolio loss mitigation of just under $3,500. Needless to say, this would be a terrible trade. Hopefully, Mark Spitznagel will share some tips on overcoming this issue in his upcoming book, but unfortunately, I believe this is the part that truly separates amateurs from professionals. In fact, this situation reminds me of one of Jamie Mai's trades during the European debt crisis. If you'll remember, Jamie Mai founded Cornwall Capital, one of the funds profiled in the movie The Big Short. Back in 2010-2011, Mai was bearish on the euro, but he found himself in the same situation we are currently contending with. Implied volatility had gone through the roof, meaning put options on the euro were prohibitively expensive. So he went ahead and purchased an exotic type of option called a worst-off option, which consisted of puts on 2 crosses, the euro versus the Australian dollar and the euro versus the Swiss franc. Worst-off options are cheaper because they pay according to the worst outcome. Moreover, the Swiss franc and the Aussie dollar now traded in opposite directions following the 2008 crash, so one or other of the currencies should, in theory at least, protect the seller. In this case, however, Jamie Mai was betting the euro would weaken, declining against both currencies, so it didn't really matter. In other words, he paid very little for a bet incredibly skewed in his favor. Long story short, Jamie Mai was able to execute the trade at approximately 1/10 of the cost, eventually reaping returns of 600% on that bet. Understanding the philosophical framework is half the battle, but it would appear the other half lies in using historical correlations and roundabout methods to make cheap volatility purchases.